I think if we look at the last 2 weeks, right, clearly the stock has been under pressure, no doubt about that. I think when we announced on our earnings call that we were taking the dividend down to 4 cents a year, we didn't do anything positive for our retail shareholder base, and they have been exiting the stock, I think, as a result. And at the same time, we took another unpopular decision, but one that was straightforward, and that is to take guidance off the table, given the fact that we didn't really have, I think, the confidence and conviction that we would want, particularly around our power business, as we look toward the end of the year. That didn't do much for our institutional holders. But I think if you step back from all of that, and given the way the stock's traded, I think we'd make those same decisions today because those were the right decisions to make sure that the company is facing forward and dealing with the fact that we do have a lot of leverage. I think we all agree in that regard. But we have a number of options to bring that leverage down over time, and the company is very committed to doing that.
Yeah, I mean, that was a focus to a certain extent of the conference call that took place 11 days ago, or wherever we are, roughly. And it also was the focus of Mr. Tusa, though. It wasn't necessarily about liquidity as much as it's what he thinks is excessive leverage at GE. And you seem to agree, although the numbers may differ a bit. But what can you do, particularly when it's not just the amount of debt, but it's also the fact that EBITDA and free cash flow is not going up?
Right, right. Well, a couple of things there, David. One, I think that's an important distinction you just made relative to liquidity versus leverage. 2 weeks ago, folks were, I think, understandably asking the liquidity question. I think we've put that to rest, given the fact we've got $20 billion of cash. We have a robust Tier 2 CP program and $40 billion of bank lines. We've only tapped 2, but I think that gives us a foundation.
You've only tapped 2 of the $40 billion available to you.
So that gives us a foundation to really talk to the leverage. And again, whether it's an equity analyst, whether it's the rating agencies, witness the downgrades, or what we've said ourselves, we need to bring the leverage down. And I think we've got plenty of opportunities through asset sales to do that. In the last 6 weeks, this is my mark 6 weeks on the job, I've heard from lots of people across our markets, people who have interest in GE assets. And I think that's confirmation that we have quality franchises and, frankly, that we have options.
Are you going to quicken the pace of asset sales at this point? Is there a sense of urgency?
Very much a sense of urgency, David. But as John Wooden, the famous basketball coach, said, be quick but don't hurry. And I think that's the mindset that we have. If we look at healthcare, for example, a tremendous franchise. We talked in June about an IPO there where we'd take 19.9% of the proceeds as cash. We have flexibility. We have options there. We could preserve our tax-free spin status while selling up to 49.9%. So there's a lot of cash there, given some of the estimates of value that are out there. We're tracking very well with the closure of our merger with Wabtec, with our transportation business. We'll end up with just under 10% of that business in equity, another option there. And Baker Hughes. A lot of people have talked about Baker Hughes, a $28 billion market cap company as of Friday's close. We own 62.5% of that company. So lots of options just in those three to generate real cash to bring that leverage down.
Right. On Baker Hughes, why not just move? Why not accelerate that now? You know, people have been focused on it. I know the price of oil is all over the place. It may not be the best time from a valuation perspective. But when you referenced it on the conference call, you still used the word several years, I think, is what I saw here in terms of exiting that position. Why not get moving on that sooner?
Well, I think we're going to try to look at everything and all of our options, again, with a sense of urgency. What we're not going to do is talk with great specificity about certain opportunities, certain paths, because we'd rather talk about what we've accomplished after the fact than negotiate in public.
What should we think about in terms of leverage then? What should investors be focused on? You mentioned, obviously, it's a focus for you. You mentioned a couple of markets that are reacting to it. Your CDS spreads have widened as well. Does that concern you?
Well, I think there are a number of ways to look at our leverage levels, but let me be absolutely clear. We have no higher priority right now than bringing those leverage levels down. It's important to strengthen the balance sheet. It's important for our investors, the rating agencies, everybody with an interest in the future of this company, not to mention the fact that it's tough for our businesses to play offense as often as they should, organically and inorganically, with the balance sheet and the shape that it's in.
Another of the contentions made by Mr. Tusa and some other analysts, to be fair, is that fundamentals continue to deteriorate, not in aviation, not in healthcare, but in power. I mean, in the numbers that TUSA had in terms of your potential earnings, I know you're not giving guidance, 35 cents a share in 2019 and 41 cents a share in 2020. When you see or hear those numbers, does it make you shiver?
No, it's a cold morning here in Boston, but I haven't shivered yet because we are working very hard with the Power team to get a better grounding in our reality. And we aim to run that business differently. I don't have the conviction to offer up numbers for the fourth quarter, let alone 19, that we will in time, right? And that's very much what this week's about. It's what the last 6 weeks have been about in terms of getting closer to the opportunities and the challenges in that business. The unfortunate thing there, David, is we probably held on, with the benefit of hindsight, held on too long to a too robust revenue outlook for the year. We're going to fall short of that. That hides a lot of the progress the team has made in terms of cost reduction. We've taken out over $700 million of cost in that business this year. We've reduced our facility footprint by 20%. Good things to do in a manufacturing business, but it's not enough.